as you can imagine, the underlying transaction surrounding this asset of the subsidiary that has to be value adjusted at acquisition date can really change to be a lot of different scenarios. What I want to show you through this presentation is that you still can identify all the differences for which consolidation journal entries would be necessary by just following this suggested work method. You always have to identify what happened to this asset in the separate financial statements of S, then compare that to what should have been recognized in the group, and your differences will lead to the correct consolidation journal entries. You not only have to identify the amounts of the differences, but also the line items affected. At the end of 20X10, these buildings have now been sold by S. So that's what we're assuming in this example. So none of my consolidation journal entries should change the carrying amount of the buildings anymore, as it's not included in my starting point. But I have to account for the effect of all these differences since acquisition date, as they could have moved to different line items of the subsidiary that needs changing. So the subsidiary didn't value adjust at acquisition date, had depreciation for 10,000 Rand for 2 years, and at the end of the second year sold it for, let's say, 110,000 Rand, which would be the same for S and the group. That resulted in a profit on sale through profit and loss of S of 30,000 Rand. Once the subsidiary sold this asset, there will not be any further differences. But we can't ignore the differences since acquisition date. As I've said, it could have moved to other line items of S. In the group, the asset was value adjusted to 120,000 Rand, and consequently we had these differences identified since acquisition date. But because the carrying amount of these buildings in the group was 96,000 Rand, the group can only recognize a profit on sale of 14,000. So I now identify a new difference of 16,000 Rand, and it's on the line item profit on sale of asset. So all my differences being the 20,000 Rand at, the 2,000 additional depreciation in X9, and the 2,000 Rand additional depreciation in X10 still needs to be adjusted for, but I now have an extra 16,000 to adjust. Let's now write the consolidation journal entry that would adjust the necessary line items. I always start with the adjustment to the at acquisition equity of S because of the required adjustment to the net assets at acquisition date. That will never change. That credit you would have to process every single year that you consolidate this group forever until there's no longer a group. But now the debit leg cannot be to the buildings anymore, as the buildings have been sold by the subsidiary. So the line items of S that I have to change, based on a discussion we've had in example 7.9, would be as follows. For the 2,000 Rand additional depreciation for X9, I have a debit to retained earnings. I sold the asset at the end of 20X10, so I first had to have that additional depreciation of 2,000 Rand for 20X10, and now I have this 16,000 Rand that I need a journal for, and I've identified it to be the profit on sale through profit and loss of S that needs changing. So the debit for the consolidation journal entry to have it balance is 16,000 to my profit on sale through profit and loss. If I had to calculate my non-controlling interest opening balance and profit attributable to NCI in an example like this, the 2,000 Rand would again have been adjusted against the opening retained earnings of S before I attribute to my NCI opening balance. And now I've written two journals to the profit and loss of S, which I would have to adjust against the profit of the subsidiary before I attribute to NCR. The question we always ask is, how would this journal entry now change if I move 1 year into the future or even 10 years into the future? So how would this consolidation journal entry change in all subsequent years? I still identify all my differences from acquisition date. Now I just have to ask, what is the line item in S where these items have moved to, where I have to adjust by way of a consolidation journal entry? And if you look at the debit entries in 20X10, the 2,000 Rand for X9 is already at retained earnings opening balance. Then I had 2 adjustments through profit and loss. So where do you think these amounts will move to in 20X11 and all future years? Yes, all of it will now move to retained earnings opening balance of S. So if you were in a subsequent year and you had to consolidate, your consolidation journal entry would be credit revaluation surplus at, keep on creating that, otherwise you will have incorrect goodwill. And now the debit leg would be to retained earnings opening balance for the full 20,000 Rand. And this is typically something that could be expected from you. The acquisition date can be 20X1 and we can ask for the consolidation of 20X19. Keep on calculating your differences from acquisition date. At some point, something would either have happened to the asset or you just keep on adjusting for that 2,000 Rand additional depreciation until 20X19. But in the end, once you've identified your differences and the line items of the subsidiary where you have to adjust for them, you should be able to write this consolidation journal entry. Then remember, once you've written your consolidation journal entries, you have to be able to pull the effect thereof through to the line items in the consolidated financial statements.